Hello everyone, this is ERC Group 4's final project, and let's get started. Nationwide has come a long way, starting out as a small insurer for farmers to one of the largest insurance and financial companies in the world. Like many firms within this industry, the financial crisis of 2008 hit Nationwide hard, and there were many lessons to be learned. Fortunately, Nationwide is considered ahead of the curve on enterprise risk management, and is an excellent example of how this commitment to enterprise risk management allowed the firm to generate success and increase sustainability even in a sluggish economy. First, let's take a look at the history in the making. Nationwide was founded in 1925 under the former name Farm Bureau Mutual Automobile Insurance Company and officially began business in 1926 after selling its first policy. Initially, the company offered automobile insurance to members at cost, and after several years expanded its product offering to include homeowners and property insurance, establishing Farm Bureau Mutual Fire Insurance Company in 1933 and life insurance through the purchase of American Insurance Union in 1935. The 50s marked a time of growth along the East Coast, and in 1955 it adopted the Nationwide brand name, renaming its principal companies Nationwide Mutual Insurance Company, Nationwide Mutual Fire Insurance Company, and Nationwide Life Insurance Company. East Coast growth and expansion continued on into the 60s and 70s. The company's success thus far promoted further growth initiatives to establish a presence in the West. The company underwent many changes over the next 2 decades, beginning with an organizational change in 1981 when John Fisher became chairman and CEO of Nationwide Companies. At this point, strategic objectives focused on growth through product diversification and expansion into Western states. In order to achieve better geographic balance, the Western Development Project was initiated in 1982. In 1985, Nationwide saw an opportunity to achieve its objective to diversify their product offering by expanding its commercial business through the affiliation of Wausau companies. We will go into further detail on this topic in the next slide. Acquiring of the company is a common move for large businesses that want to expand their own operations and adopt new resources that they otherwise would not possess. The Wausau companies had expertise in commercial insurance for large corporations with specialization in workers' compensation. In the 80s, this company had struggled financially, and Nationwide saw this as an opportunity for growth. Nationwide provided funding to bail out the company in 1985 by providing $250 million in operating loans, and another $150 million was loaned over the years. The Wausau acquisition supported Nationwide's changes in operating strategy to expand and diversify. Nationwide would now have an established presence in the commercial insurance market for large national and multinational accounts, making it the nation's 4th largest property casualty operation. Shortly after the Wausau acquisition, a surge of liability claims hit the commercial insurance market hard. Wausau companies had joined Nationwide's underwriting pool, revealing Nationwide's lack of expertise in underwriting large commercial accounts, which led it to underpriced products in the Western Expansion Project. To add to the headache, Wausau's continuing operations deteriorated as well. Nationwide had participated in the share of the profits and cash flows of the continuing operations of the combined companies. As a result, Nationwide's capital position, measured by a premium surplus ratio, suffered. The company entered into a period of retrenchment, forcing them to shut down its commercial operations in the West and restricting growth across the business. Fortunately, the 90s marked a turnaround for Nationwide. As capital position began to improve, Richard McPherson, who became CEO in 1992, was concerned about Nationwide's stagnant market share in its traditionally strong property and casualty lines, and shifted strategy over to focus more on becoming diversified financial services providers. In order to support this shift in strategy, in 1997, Nationwide Financial went public, issuing shares representing 20% ownership interest. The sale resulted in cash dividends of $800 million, which is a major source of funding for investment opportunities. In 1998, Nationwide Life then pushed towards globalization, exploring a number of asset management acquisition opportunities. By going public, Nationwide had a shift as to where their allegiance and obligations lay. As a mutual, their focus was solely on policyholders. As a publicly traded entity with shareholders, they now had to focus on the public best interest and how to promote investor returns, rather than sole safety and service of the policyholders. Given its now outward responsibility, Nationwide had to observe more fiscally conservative measures. This is not to say they were wildly speculative prior to the offering, but with quarterly reports and more broad regulatory market oversight, financial safety became even more paramount than it was prior to the 1997 stock issuance. One drastic change related to going public was the requirement to utilize generally accepted accounting principles, as opposed to its statutory and proprietary measures that had been utilized previously. The change to GAAP yielded capital strength within Nationwide Financial Services, but also did not allow for comparison amongst business units as various measurements, including earnings before interest, taxes, depreciation, and amortization, and trade combined ratio. This was a source of concern as Nationwide's financial systems were ill-equipped for efficient GAAP reporting, with a number of different ledger systems in its various subsidiaries and no centralized account policy. That said, the core difference between public companies and mutual companies is in the ownership. Public companies can be owned by anyone, regardless of affiliation with the company or status as a policyholder. Mutual companies are owned solely and exclusively by the policyholders. Thus, the difference between the two becomes either drastic, as you consider the requirements of either party. Public companies, again, are implored to do what is best for the shareholder. This can mean any number of things, but specifically requires adequate capital to meet business needs and generally to provide a dividend or return. Lawsuits and other expenses become a reality, requiring the public company to maintain additional capital and reserves to meet ongoing and upcoming obligations. Diversification takes on a new meaning as the public company must consider forward-looking markets and attempt to secure its assets to not only meet its business obligations, in this case claims, but also to provide liquidity to the company in general. This is to say that a publicly traded company has different goals for economic capital and diversification when compared to a mutual or privately held firm. A 2009 article from CBS provided a quote from ratings agency AM Best that appropriately outlines the difference between public and private or mutual companies. Mutuals, which are owned by policyholders rather than shareholders, who demand dividends and price appreciation, are perceived to be relatively safe, can offer more competitive prices in most instances, and do not have the same pressure in terms of returns to shareholders as stock companies. The expectations of shareholders of publicly traded companies are different and oftentimes in direct conflict with the expectations of policy owners. Shareholders desire some return on their investment. This can be through a dividend paid out or through appreciation, which is generated through competitive advantage, low cost, high revenue, and a fundamentally sound business practice. This requires lawsuits and claims to remain as predicted or lower. But outside of this, little or no attention is paid to the actual business of how insurance is issued. Shareholders just want a return. Some shareholders are also using these investments to diversify their portfolio. This is done to reduce risk and market correlation and does not focus on the individual claims process or policyholders. Policyholders of mutual companies have a different focus. They are pooling their risk with other individuals to lower their average claim rate and share their individual risk with a group of individuals looking to do the same. The more they can spread the risk, the smaller portion of risk they all retain. This can help in lowering premiums due to the efficiencies of the insurer with claims processing and administration. The policyholder's expectations are also focused on the ability of the insurer to pay claims and reduce the policyholder's risk retention, which is drastically different than shareholders who are seeking a return. Being a public company invites additional regulators to monitor the company. The National Association of Securities Dealers and New York Stock Exchange, now the Financial Industry Regulatory Association, were given domain over Nationwide as they traded on public exchanges and had shareholder money at risk. Financial statements, quarterly reports, and annual reports were now required in a standardized and consistent format to provide information to the public. This is done to ensure that the financial health and well-being of the company is on full display to the market. The market regulators are generally not caught up with the day-to-day operations. The regulators' expectations are on maintaining a fair and orderly market and that each company comply with any outstanding rules and regulations. Insurance regulators are concerned with claims paying ability and focus on this regardless of it being a public or mutual company. This is to say that additional restrictions and regulators are involved when a company goes public. Ratings companies are aware of the different expectations and as were noted in the CBS News quote earlier. Subsequently, in order to mitigate risk and please the shareholders, it was in Nationwide's best interest to terminate the 13-year affiliation to Walsall Insurance. According to company history, Nationwide had underestimated by $1 billion what it would have to put up as a cushion against losses at Walsall. During that time, Nationwide had also agreed to add Walsall's retrospective claims, including its asbestos and environmental claims, to its underwriting pool, preserving Walsall's franchise value by using Nationwide's capital base. As market conditions prevailed, Nationwide began making changes aimed at increasing market share and profitability. Their decision to go public added strength to their capital position, but in order to gain competitive advantage and increase sustainability, Nationwide could no longer assume the risk and exposure from Walsall. As a result, Nationwide decided to end its affiliation to Walsall and focus on gaining position in the global financial services industry. Nationwide is one of the largest insurers in the U.S., which provides them the opportunity to leverage their operational advantages. They are also able to bring to market new products at competitive rates. With enterprise risk management, Nationwide can bring more focus to the organization. Asset allocation has increasingly become the foundation of individual as well as institutional investment portfolios. Asset allocation entails exchanging the potential to reap a higher return and the risk of taking an equally dramatic loss for the likelihood of generating a more consistent positive return over the long term. The basic concept is that rather than devoting the majority of your assets to a particular sector or even one specific investment, you choose different types of investments. Essential to the decision is the assumption that each asset class will react somewhat differently to a given event. Nationwide has adopted the objective of realizing an efficient, consistent portfolio, and to that end, the thinking has to shift from that of risk reduction to risk optimization, focusing on the types of risk from an impact perspective and determining the risk-reward relationship of that opportunity. These objectives are consistent with the firm's mission of maximizing shareholder value because it offers the opportunity for consistent returns while protecting against a dramatic loss. Proper execution of the strategy hinges on matching assets to liabilities because failure to do so can lead to the firm being unable to meet obligations due to an inability to achieve timely liquidity. Another risk is that of correlated losses, where assets are so closely correlated with liabilities that sudden increases in liabilities could lead to a drastic drop in assets. Lastly, shareholder value is put at risk when excessive amounts of capital get tied up in assets. In those instances, there is an evident opportunity cost that can prove detrimental to the shareholder. These and other risks are what have led Nationwide to utilize new measures such as economic capital and dynamic financial analysis, which illustrate capital intensity and catastrophe modeling, respectively. Incidentally, these figures contributed to other major decisions such as the divestiture of the asset management business and reducing its risk exposure in Florida by not renewing 52,000 policies. Just some of the many business decisions it has to make. Company management and third-party credit agencies agree that recent events reflect of Nationwide's enterprise resource management strategy. Gartmore, a leading UK asset manager, was purchased by Nationwide in late March 2000 for a sum of $1.6 billion. 4 years earlier, the same asset had been sold for $730 million. According to an analyst with Merrill Lynch, Nationwide surprised competitors with the deal and paid a slightly higher price than the market expected. Other bidders for Gartmore included CGU, Credit Suisse, and ABN AMRO. The acquisition was based on pension plans being privatized and individuals accepting pension plans that required asset managers, in addition to Gartmore's broad asset base and Nationwide's desire to become a force in the European market. Hindsight can provide a valuable evaluation, not only for Nationwide to discover what went wrong, but also for other companies who are examining a large purchase or entry into a new market. There are numerous factors and considerations that should have been used to evaluate the initial decision to purchase Gartmore. In an attempt to categorize these factors, we will break them down into 4 categories: company strategy and outlook, asset and product space, market and portfolio considerations, and outside factors. In the company strategy and outlook category, Nationwide has benefited from engaging, projecting, acting in several different ways. In regard to the growth strategy, the purchase of Gartmore was an option for Villanobis, Nationwide's asset management business. Stated growth strategy of buying smaller companies. Utilizing hindsight, the deviation from their sound small business strategy was an incorrect one. Nationwide and Villanova did a poor job of evaluating, adjusting, and implementing a new combined management structure. A different culture and expectations led to the loss of key fund managers, which could have been avoided with a more functional and diverse integration plan, with clear expectations outlined for each business unit. There appears to have been no timeline for the growth of the newly acquired firm, or a designated methodology for how to integrate the business units. Clear objectives should have been developed and discussed throughout the company to ensure the global strategy filtered down to each and every associate. Nationwide had clear projections of the growth of the market and the asset management business. Projections are often better left conservative with an under-promise, over-deliver mentality. Instead, it appears that Nationwide overestimated the sheer size of Gartmore's asset base, the growth of individual pension plans, and the European demand, which led to an eventual failure of the acquisition. A look back at Nationwide's acquisition of Gartmore would also yield some additional insight and potential changes when considering assets and products. Villanova had $22 billion in assets under management and had developed a managerial style to suit these assets. Gartmore had nearly 4 times the assets that Villanova did, leading to a different culture and style. As might be expected, integrating 2 different styles and asset bases can prove to be challenging, something Nationwide knows from this acquisition. One of the larger failings in this acquisition was a lack of utility and shelf space given to Gartmore. Nationwide continued to push their products, including their Best of America variable annuities, with select sub-accounts, while ignoring Gartmore. No shelf space or special attention was given to Gartmore, leading it to be underutilized. The question to ask in hindsight is, if you are going to acquire almost $88 billion in assets of asset management servicing, shouldn't you use it? The market on existing portfolio, both security and risk, should also be considered in an acquisition of this nature. With the benefit of hindsight, it is easy to see that this acquisition would have to weather difficult times in the market to be successful. With the tech bubble bursting shortly after the purchase of Gartmore, market sank and the value of assets became severely depressed. It would have been close to impossible identifying the potential calamity in the market, and negating or postponing the purchase would have served Nationwide well. Nationwide also tied up all of its financial services eggs in the same proverbial basket, relying on the pension fund movement and asset management arm of financial services. This provided little to no product or strategy diversification, though it did provide some geographic diversification. The problem was the geographic risk could not be diversified out, as the markets are truly global, leading to a higher correlation. Nationwide should have evaluated its existing portfolio and asset portfolio to see how this move benefited the company, shareholders, and if it provided additional risk or reduction of risk. The market price that Nationwide paid was 119% higher than the previous sale price, and drew words from Merrill Lynch about it being higher than anticipated. In hindsight, Nationwide may have reached to secure this asset, paying a higher price and ultimately making it more difficult to realize a return on this purchase, particularly when viewed in conjunction with the failing markets. Other outside factors from Nationwide also impacted the purchase and sale of Gartmore. The ratings agencies monitor insurance companies and provide outlook and ratings based on a multitude of factors. Though AM Best affirmed the financial strength of Nationwide, Standard & Poor's did indicate it may downgrade the financial strength and ratings of Nationwide based on the dilution of earnings from the Gartmore deal. This lends itself to hindsight evaluation as to the size and structure of the deal. The last factor that should have been considered is how to leverage the marketplace and existing synergies in place. Both Villanova, Nationwide, and Gartmore were successful in their respective industries. There was no attempt at leveraging their advantages or finding their synergies in existence. Rather, Nationwide tried to fit Gartmore into its model without considering what the two companies could do together. This, along with other factors listed, should have been considered when the initial deal was being discussed. Management's decision-making process in regards to the Gartmore acquisition would have been different if it had occurred after, not before, the ERM framework was established. At the time of acquisition, the purchasing rationale was based on the fact that Nationwide needed a new source of revenue, and asset management companies had experienced high growth. However, Nationwide did not have a comprehensive and integrated risk management program in place to assess the long-term risk factors associated with this acquisition. Nationwide's decision process should have started with a comprehensive assessment of all risk categories applicable to the acquisition of Gartmore. Beyond the identification of risks, Nationwide should have spent considerable time measuring the risk in terms of probability and severity, and analyzing it to understand risk components, expected losses, and assess correlations between different types of risks. The different risks also need to be prioritized. Based on the risk assessment, Nationwide should have decided how to best manage the risk by avoiding, reducing, retaining, transferring, or exploiting them. It would have also been crucial to continuously monitor and review risks for changes and adjust the risk management strategy appropriately. Only after the individual risks would have been assessed should Nationwide have aggregated all risks on an enterprise level and used an enterprise risk model to calculate risk-adjusted performance and capital adequacy, which is the maximum amount of risk that can be supported by the company. Governance is provided by Nationwide's Board of Directors. Based on feedback from the risk assessment and risk model, the board should have decided whether the acquisition fits the company's risk culture, and meets risk policies. Enterprise risk management is only effective if it is fully integrated within the company's strategic plan and capital management approach. Nationwide should have taken both into consideration to ensure fit. Last, to successfully manage enterprise risk and make a sound decision on whether or not to acquire Gartmore, Nationwide should have taken into consideration whether the company can support the management of risk in terms of infrastructure, communication, and the firm's external environment. There are several factors that contributed to the Gartmore acquisition not going as smoothly as other diversification attempts. First, Nationwide acquired Gartmore at an inflated price, anticipating high growth rates in the near future. The acquisition started off with a negative ROI. Not only did demand for asset management not increase, but as a result of the burst of the technology bubble, revenues declined and Gartmore experienced significant losses. After Gartmore was acquired, the decision-making authority for this business unit was transferred to Nationwide's U.S. fund management, despite the fact that this group had little experience in European fund management. This was an unfortunate decision because most of Gartmore's value resided in the company's asset management team. Many members of the group were disgruntled by the loss of management control and left the company, causing a further decline in value. The lack of a comprehensive culture, vision, and collaboration between Gartmore and Nationwide provided the largest obstacles to successful acquisition. Instead of developing a symbiotic relationship, Nationwide cannibalized Gartmore's products by not providing exposure in their premium product lines. Managers of Nationwide should have considered the following questions when making diversification decisions. Is the valuation in the acquisition very sensitive to changes in the equity market? How do external factors impact ROI? What are the possible scenarios? How does the acquisition affect the management structure of both companies? Can the acquired management team be successfully integrated to minimize turnover and retain expertise? Does the focus on growth through diversification compromise the parent company's strategy? Is there a cultural fit between the companies? Can mission, vision, and strategies of parent and subsidiary be integrated without compromising the maximization of value of either company? On behalf of Brian, Adrien, Katharina, and Brent, this is Jason saying thank you for watching the presentation. We hope you enjoyed it. If you have any questions, feel free to holler at us, and we'll go from there. Thanks again. Bye.